Hey everyone, welcome back to the channel, your number one source for income-oriented investing. The honest truth about living off high yield covered call ETFs. Wow guys, I would have never in a million years suspected that this video would get as much views, over 15,000 views in just 4 days. Absolutely incredible. Lots and lots of comments, lots of engagement as well, positive comments, and of course negative comments as well. And believe it or not, this video, I had filmed it a little while ago and just put it in my backlog as a filler video. Of course, what do you know, the filler video gets the most views. It's pretty incredible. So I just wanted to do a quick follow-up and review some of the comments that I got, positive and negative, because some are some really thought out comments where we could, I could maybe discuss a little bit more what I really meant from this video. But really the premise behind this video, guys, was really to discuss the fact that these newer, very high yield funds like QQQY, JEPY, Tesla, Clip, I'm talking about the really high yield ones. I just don't want people to get the interpretation or the feel like they could live off them, because another part of the video is I wanted to discuss what is living off dividends. What does that actually mean? Because some people it means different things for different people, but I think most people think living off dividends means I'll just extract all my income, I'll live off the dividends I get, and I'll be okay. So this video was just to warn you that maybe certain funds, like the newer funds, it's not feasible to do it with these specific funds where you're just taking out everything. It doesn't mean you can't do it. You can do it, but you need a little bit more management, a little bit of portfolio management. You can live off pretty much anything, even QQQ or VOO or VFV, but you have to set an extraction target date, right? So I know most of you really understood and appreciated the premise of this video and me talking about it. Some of you, I guess, didn't and say things like, I got quite a few negative comments from some recurring haters, I guess, saying that, oh, he changed his tune. That was a common negative comment, that I'm changing my tune. I don't understand what you mean by that, because these funds like QQQY and Clip, they're relatively new, and I've never really talked about living off these really high yield funds. So I don't know what the heck you're talking about when you say change my tune. I feel like my message has been very consistent throughout. I guess they think that I've said before you could live off the interest, and you can, but it depends on the fund. These are new funds that didn't exist back then. I'm just saying that there's a lot of funds, by the way, that you can live off of. That's why I gave the QQQY and the JEPQ example, right? Like a JEPQ, you can live off of it, but can you live off of QQQY or Tesla or Clip to just extract everything? Not really ideal, because if you understand the fund, that was really the point of the video. I say at the end, you gotta understand the fund, how it works, and then make a decision. Could I extract all the income? Maybe with QQQY, you got to reinvest a portion. And I just gave that comparison to JEPQ. Even that 12% extraction target, that's just an opinion. You could set it at 10% or 15%. It depends on the fund. It depends on you. So I was trying to get your wheels moving and really think about living off of dividends. What does it mean for you? And certain funds, these really high yield ones, are not exactly designed to just pull all the income every month, because you could expect a gradual lower distributions over time. That was really the point of the video. It's education. I just, I don't know why people say changing my tune. I've never actually talked about living off of these high yield, really high yield funds in the past, because they're new anyway. So I don't know what people are talking about, but whatever, it's all good. So that's really the general premise of the idea, right? It was about, be careful how you define living off dividends. If your definition is I'm just going to extract everything every month, well, pick and select the funds that really make sense to do that. And by the way, if you want me to make, and what we're going to do now is just go over some comments, some really thoughtful, great comments, as well as some negative ones of people who really get it and have some really good ideas as well. So we'll go through those. But before we do that, let me know if you're interested in another video where I actually discuss and review the funds I feel are ideal to live off of, if you're defining that as extracting all the incomes. Because there are, I think I put a lot of them in my hold forever ETF videos, but let me know if that's an interesting video, if you want me to do on the Canadian market, on the American market as well. If you really want me to review, look, okay, Adrian, what are the funds where I should be okay extracting all the income? If you're interested in that, let me know. And I'll do another video on that, not a problem. So now let's look at some comments, some very interesting comments here. Negative and positive, but let's just go through them and see what we could find. So this is from KD Passive. Be very cautious. You want to grow your wealth, not destroy it with these funds. I have to disagree with that. Again, it comes down to understanding the funds, how they work, looking at the total return, not just the stock price. NAV erosion is a myth, blah, 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 blah. Also, this is why I really put this. I found it was very funny. It made me die of laughter. Also, this man looks and sounds nice. He'll bite you if you're not up to standard. Even after being nice to him, I guess that's me, Adrian, continue to be rude, I guess. Only worth if you have a lot of money, lazy, too much hard work. I don't know what she says there. Even if you get 10% yield after taxes, navigating erosion, it's not feasible. Even someone here, Todd Ricketts. So Todd Ricketts, I believe, is another serial hater, I guess. No problem. Makes no difference to me, but I just found it was funny. I even wrote back there, I look and sound nice, thank you. So I found this was quite funny. I believe I know who this person is. It's a woman from Australia that at one point just kept sending me emails after emails asking me questions and stuff about Bitcoin and crypto, or are you getting into it and whatever. I think at one point, if I remember correctly, because I get a lot of emails, I told her, look, I can't really give you advice over email. I need to know your situation. Book a one-on-one if you feel it's necessary. And I think that's, she got angry at that response. So listen, I wish I could help everyone via email, but I can't do that. And that's why I offered the one-on-one booking session. Anyway, moving on. Next comment. So what will the NAV and distribution rate of one of these high yielding funds look like 5 to 10 years down the road? Great question. And I responded, I think it will probably be lower. Right, if you understand how, and we're sticking with the really high yield one now, guys. Remember, I'm not talking about like HYLD and HDIF and HDIV and USCL and JEPI, JEPQ. I'm talking about QQQY, JEPY, CLIP, the really Tesla, the YieldMax, really high yield, like over 30, 40, 50% yield. So it's a good question. I feel that, of course, the NAV and distribution rates will probably be lower in 5 to 10 years. They will go lower over time. But again, you need to understand how these funds work and look at the total return, right? That it goes back to that NAV equals erosion. I feel it's a myth. I have 2 videos on that. Watch those videos where I discuss this. But again, it comes down to, you got to look at the total returns. I'm fully invested in QQQY and JEPY on drip in my retirement accounts. Don't you think that if I thought they were bad funds, I would invest in them? And I'm in a net positive if you count the income. So it's about total return, basically. Don't focus too much on what the NAV and the distribution rate is going to be in the future. Focus on the total returns and what the total return is, because the NAV is not eroding, in my opinion, if they're giving it out to you in income, right? It's not eroding if you're getting it, right? So next question, next comment. Great points, man. JEPQ and QQQY are basically the same. So many people don't understand this fact. Great video. So thank you for that comment. Obviously, from the guy's name, the covered caller, obviously I'm assuming he knows how covered call ETFs work. And he's right. JEPQ and QQQY, they both have access to the NASDAQ. They both use option strategies. The risk level is basically the same. This is why in the video I actually do a comparison. And if you do a comparison of their total returns, QQQY is very new. But still, if you do a comparison of their total returns, are very similar. Even though QQQY is down from its when it first started at $20, and JEPQ was very similar. So they are basically the same. Exactly. So next one. Not sure about all of you, but I'm now parking my investments in closed-end funds, which have 30+ year records of dividends. Yes, zero or low dividend growth, but that's okay. But 2020, it's all about total returns again. 2024 is starting off really iffy, and then he gives some example, HYT, BST, which rings a bell. They're BlackRock closed-end funds. Someone else just wrote EIT. And hey, this is someone who's using their brain and figuring out something, a different strategy that's best for them to go with funds that have more of a track record. I do get this question a lot. Aren't you worried that all these new funds are new, they don't have a track record? I'm personally not worried about it, because the S&P 500 is not new. The NASDAQ 100 is not new. The stocks inside these funds are not new. Just the strategies are. So I'm not worried that the funds are not new. But if you are, There are plenty of funds, and even closed-end funds, by the way, which is much bigger in the US. BlackRock has some of the best ones. There are trading at big discounts right now. In Canada, EIT is the king, EIT is the best. Do whatever makes you feel more comfortable, guys. It's a great suggestion. You're a great insight. So thank you for sharing, by the way. Here's a negative. These covered call option ETFs have decent yields. Look at a lot of likes here. They have decent yields, but their NAVs will erode over time. Not a good investment. Again, I would have to strongly disagree. I think NAV erosion is a myth. Again, watch that video where I go through my points, my proof there. It's about total return. It's about quality of life as well. You got to invest for whatever are your goals. So I would have to disagree with this one. Obviously, a lot of people agree with this. And hey, if you're not comfortable with these ETFs, don't know how they work, or you don't like seeing that declining share price, or these are covered call ETFs. If you're getting high yield, you can't expect the stock price to go up again. Sounds like you're more of a growth investor. So just stick with the passive index ETFs. Great strategy as well. I have nothing against all these, all different investing strategies. Next one from Mr. John Taylor. I didn't hear anything in this video to tell me that I shouldn't invest in any of the YieldMax ETFs. No, I'm not telling you not to invest in them. Just that it shouldn't be my sole source of income. Is that a correct understanding? Yes and no. It can be, but you just need to have portfolio management. If all you have is QQQY and the YieldMax, you could live off of them, but you can't really, it's not feasible to extract all the monthly income. You got to reinvest a portion. That's really my point of the video. It's about portfolio management. I'm not saying don't invest in them or don't invest in them to live off of, but if you have them to live off of, you got to be tactical and do portfolio management. And I think this guy here gets it. The main point is you need to reinvest some of the money to maintain the NAV. Not really to maintain the NAV, but he pretty much gets the point, he or she. To maintain the value of your portfolio is a little bit better, right? That's why you have to reinvest a portion of these really high yield ones, right? And here's another serial negative commenter, I believe, Rick Nash. His tune is changing. Now the NAV is important. The crazy yield ETFs have taught him that. All right, buddy. Yeah, whatever. Good assumption, I guess. But my tune has never changed. My tune has always been the same. You got to be responsible. You got to understand how these funds work. And this is the first, again, I talked about this before. This is the first time I talk about these really high yield funds. So I don't know what he's talking about, how my tune is changing. Anyway, next one. You explained this very well. I think you could pull more than 12% out per year with these funds, but for sure you will need to invest at least half the income back into the funds. Again, someone who's using their brain and is figuring out what is the best strategy for them. I just use 12% as an example. I feel the magical range is between 10 and 15. Depends on the fund, depends on you. It depends on many things. But yes, you could pull out maybe more than 12, and some people more conservative, they pull out 10 or 9 or 8 to make, so whatever makes you feel most comfortable, guys. I'm always trying to educate you and trying to teach you how to fish on your own, not to give you the fish, right? That's always been my goal here. Here's another one here. Originally from Montreal. Hello, Bella from Montreal. I have a portfolio where I yield approximately $195,000 a year. That's fantastic. In 10 high yield dividend ETFs such as these. I have JEPQ, SPYI, also Tesla and AIYY, OARC, so some YieldMax ones, right? Those three are YieldMax. However, I don't spend any of it and reinvest all. I use it as a cash flow mechanism to spread my money around, to buy some growth and dollar cost average into Tesla or others when they are down. When I get ready to use this money in 6 years, I agree with you to only use 30% of it and to reinvest the rest. I can't tell you how happy I get when I see these comments where the underlying theme or the commonality of these type of comments is people are thinking for themselves and having a plan or figuring out their own plan, their own way of doing things. And when it comes to do-it-yourself investing, guys, there's a million different ways to do it. There is a million different ways to do it. And I did a video in the past, different ways to use the YieldMax or these really high yield funds. I know some people who just extract all the dividends to put them all in VOO or a growth ETF. Some people reinvest half. Some people reinvest all of it. Some people, there's a million different ways. And I know a lot of newer investors get confused by this. Okay, what do I do? What's the strategy? Trust me, with experience, with time, you'll figure out what's the best for you, just like Bella has already done. So congratulations, Bella. Really like this comment. Thanks for sharing, by the way. Appreciate that. Here's another one. I must be missing something here. If I withdraw all of the dividends from a JEPQ to live off of, I can only withdraw 12% of QQQY and have to invest the rest. Well, I was just giving the example or the comparison between QQQY and JEPQ. The reason why I use 12% is because JEPQ, the yield is about 12%. You know, it's between 10 and 12 or something like that. And I feel like JEPQ is a fund you can live off of. So obviously the direct comparison, a NASDAQ comparison, very similar fund is QQQY. So 12% is just a number because of JEPQ is giving 12%. It's the same as, it is the same as kind of. Why not? Here's a pretty good question. Why not just withdraw the dividend from QQQY and place it in a savings account and live off that? Every month take the divs and live. Some months may be higher than others, but isn't that called budgeting? So it goes, and I wrote, it goes back to understanding QQQY, how the distributions work. They will most likely be gradually lower over time. It's all about account value management. So I don't think it's a good idea to extract everything from QQQY and put it in a savings account, because you want to reinvest back in the fund that's going to make more interest, right? There's a big difference of return between a savings account, which is pretty much zero or will be zero when rates get cut. Now it's like, I don't know what you get in a savings account, but it doesn't make sense, this strategy, because you want your units or as much reinvestment back in QQQY so you could have more of a compounding effect. So Peter, I think you're not thinking of it right. You always want to make sure your money is in the investment, not just in the savings account, so your investment could grow over time. It's going to grow more in QQQY than in a savings account. Hopefully that makes sense. This is kind of my plan for Canoe EIT, HDIF, ENCC, and a few more. These are Canadian listed funds, diversified, all oil and gas, all about between, I would say, 10 and 14% yield here. I want to get it to a point where I'm receiving a few hundred from each. And when I'm ready to retire, I will just stop the drip and enjoy my returns. I don't need much, no mortgage, I don't smoke or drink, no bad experience habits besides a bit of outdoors and coffee. Again, another comment that I like seeing, where obviously this person has a plan, figured out which funds they like because they understand hopefully how they work and they have a plan. Thank you for that comment, appreciate it. Another one, if historically total performance including dividends is much higher for non-income ETFs like QQQ, for example. QQQ, by the way, is just a NASDAQ 100 index on the US side, the equivalent to VOO, S&P 500, right? Then what is the point of dividend ETFs? I can just sell a certain percentage of my portfolio, like 0.8% monthly, and I will end up with much more remaining capital. Mathematically, income ETFs don't make sense. I actually agree 100% with this statement. And he's right. Mathematically, what he means by that, what's the point of income and dividend ETFs? You might as well stick with the passive index ETFs because they have more total return over time. Yes, it's true, but the point is many people, let me just see what I wrote. I agree with you, but math isn't everything, or total returns isn't everything, my opinion. Some people prefer to invest in a different way with less management, less unknowns. That, in my opinion, is the real benefit of these ETF. It's not maximum total return. So I do have a video coming up on this called The Truth about covered call ETFs, but the gist of it is basically, I do agree with you. I will admit that over the long term, you could be better off with QQQ and VOO, but a lot of people, they don't want to go in every month, decide how much to sell, when to sell. If there's a really bad year, you have to sell anyway, maybe at a loss. You know what I mean? So this kind of reminds me of that 4% rule of the FIRE movement, where you just extract 4%, go with all passive index funds, but sell off 4% every year and you should be safe for a long time. So I think there's a better way of doing it with less stress, less management, because you're less dependent on the stock market with these covered call ETFs. So I do admit that, this is a good comment. It's well thought out. Yes, you will get more total return with the passive index funds versus dividend ETFs or covered call ETFs, but it's really the psychological benefits, the simplicity that shine with these funds, not mathematically, not the total return. So good comment here. Here's another opinion. The guy's called BRK-B all the way, so obviously he loves Warren Buffett's company. The dividends are great. Made $6,300 from the latest dividends, but I sold all my YieldMax and Defiance ETFs due to the price per share depletion. I took the money, bought Berkshire Hathaway Class B shares. Someone else says I did the same thing. Sure, that could work. Your experience made you switch your strategy, and it's all about doing what's best for you. So this guy, you could, like I said in the video and now, you could live off of anything, but you have to change your strategy. So this guy probably just went, like his name says, with Berkshire all the way, and every month he sells a little bit of what he needs to live off of. So some people, that's the classic drawdown or extract, drawdown strategy. I don't like that strategy. I rather live off the interest. That is more preferable and it's easier. But here's another strategy here's another comment of someone thinking and switching because of finding a better way for them that works best for them. Again, it's all do-it-yourself investing, about finding the best strategy for you. Adrian, seems you are saying that if you want to extract all the dividends each month, you should invest in the JEPI and JEPQ type funds. Yes. Why would anyone want to do all the work of figuring out percentages of the QQQY and JPY? Makes more sense to just hold the JP Morgan funds. Am I missing something? No, you are not. That's exactly my point that I was trying to make in this video. If your definition of living off dividends is to extract everything, then you are better off with funds that are suitable to do so. Like JEPI, like JEPQ, like SPYI, the Canadian market, there's a bunch of them. USCC, QQCC, the leverage version, HDIF, HYLD, HDIV. So it's spot on. This comment is spot on. Basically, you got the point that I was trying to make. If you want your life to be the easiest and just you don't want to do the work or less portfolio management, well, you are going to invest in funds where it's feasible to live off of them. And again, if you're interested in you want me to make a video on which funds I feel are feasible to extract everything, let me know in the comments. Next one, here's a great comment from Angela Barnett here, who's a PII Inner Circle member. I love this comment. I do not believe in spending all investment proceeds received in any type of fund or investment strategy. Income could vary greatly. You need to invest enough to have a nice buffer for your needs. I currently live off my PI portfolio and live below my monthly income. Reinvest the rest so I could give myself a raise if I want one. Flexibility. Do it yourself. I love it. Intelligence. We have a plan. We have a brain. We're using it. Fantastic. I think it's also important to have money on the sidelines as you are reinvesting a portion of your proceeds. This way you can more efficiently plan and live behind the income you receive. Reinvest a portion of the proceeds, fill the money bucket with the rest, withdraw a portion from the money bucket periodically to live on, repeat the process. Well done. I love hearing from people who have figured out their own plan. So obviously Angela Barnett has figured out a process or investing strategy that makes her sleep well at night, that works for her. Seems a little bit more conservative than per se I am, but well done. That's what it's all about, figuring out what's best for you. Here's another comment here. Total return is what matters. Dividend is part, or distributions is part of the total return. You have to take that into account. The capital appreciation, depreciation, the risk-adjusted total return over enough time of these high yielders is usually below investing in the S&P 500 long term. Of course, again, I'm the first one to admit that any covered call fund or dividend fund even typically always underperforms the S&P 500 or just investing a VOO or a VFE in Canada over the long term. So you may think you get the best out of your money, but you're in fact leaving money on the table. Do your math. Living off dividends is usually a mind trick. Getting 11% return from S&P 500 or getting 11% total return from high yielders is getting the exact same thing, except for that the S&P 500, you sell your shares and pay capital gains. And for the higher yielders, you pay dividend taxes, which may or may not be the best thing. So again, well said, total return is what matters, but other things matter as well, like time and energy. That's the whole point. I could go with VOO. I could sell everything tomorrow, guys, and put it all in VFV or QQQ or whatever. I know in 10, 20, 30 years I'll have more total return, but I need that cash flow to get my financial independence and pay my expenses. And for me, that total return, financial independence, financial freedom, retiring early, moving to Panama, that's a humongous total return that you cannot measure mathematically. So this is why I say total return is important. It is what matters, but other things matters as well, like time and energy. And trust me, time is and your energy is much more important than, my opinion, a little bit more total return after 10 years. Quality of life. I would say it's not a trick, it's just an alternative way to invest instead of the drawdown strategy which you described. One advantage is you could reach FIRE quicker. Again, I feel like the PII strategy makes you get to FIRE quicker, which unlocks your life 2.0, and that's a humongous total return, isn't it? Almost done here. And the examples put forth, what you are implying is it is necessary to reinvest the dividends to avoid or mitigate decay in share price value, more like mitigate the decay of the value in your portfolio. Since this is most likely going to be in a taxable brokerage account, not for me, I have QQQY JEPQ are in registered account, you would be setting yourself up to get taxed on income, most of which you are reinvesting to slow down the decay of your position. Why go through all the trouble? Just stick with a JEPQ or SPYI, which has less possibility of principal reduction. So I kind of agree and disagree with some of what he's saying here, or he or she is saying, but I agree it is less trouble, again, to choose funds where you don't have to worry about reinvesting a portion, like JEPQ, like JEPI, like SPYI. I would put SVOL in that category, high in that category, a lot of Canadian ones. So yeah, I mean, that's basically it. It is less trouble, but you could still do it with the high yield funds, just like you could still do it with passive index ETFs, just that you're gonna have to put a little bit of portfolio management into it. I don't see it as living off one high yield ETF. You should build a portfolio with a mix of lower yielding, more stable distributions and higher yield that which generates large monthly cash flow. Then decide how much your lifestyle needs, right? And how much of your portfolio needs, and make sure your portfolio generates like 50%, 100% more than you need each month. If the high yielding ETFs deliver, then reinvest back into your portfolio the excess. If they have lower distribution, then you are covered to pay your monthly needs. So this is another person who's using their brain, is figuring it out, a strategy that works well for them to have a mix, the high yield and the more stable ones, and then each month you could decide. That is, again, the beauty of do-it-yourself investing. There's a million different ways of managing your portfolio, right? But living only off the high yields, too risky. I wouldn't say it's too risky, but it's just more management, as they're producing far more than you need each month, right? I wouldn't say it's too risky. Like the risk between a QQQ, a JEPQ, and a QQQY, the risk level between a VOO or a VFV and a SPYI and a JEPI and a USCL is the same. It's the same underlying. The risk is the same. You're just getting your returns in a different way. So I have to disagree with that part. It's more risky. But again, a good comment of someone who has a mix of lower yielding, higher yielding, and has their own process. So that's what it's all about again. So that's it, guys. I hope this video was informative for you. I just found it very interesting that it got such a high amount of views. It surprised me a lot. So let me know what you think of some of these comments, and feel free to share especially if you're an experienced PII investor, your strategy. Do you have these high yield funds? How are you managing with them? Are you extracting everything, which I think you shouldn't do if you're living off of it? Or you're reinvesting half? Do you have a mix? Let me know. It's always cool to share some ideas. But again, the point of that video was really to discuss the psychology of living off and defining what that means. And if you're going to define it as let me just extract everything, well, you got to choose funds and strategy that makes sense. So give me a thumbs up. I would really appreciate it, and see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.